Welcome to credit rating. Yesterday we were discussing about US subprime crisis, and I have given you a small hint that credit rating agencies played a very important role at various stages in the subprime crisis, because the bond or the debenture or any instrument which were issued during this period were not to be rated say AAA, AA, but they were given high rating, and because of that many investors invested. Secondly, the insurance company are also rated, even they were given high rating, and when people failed to pay their loan, then one by one all of them started suffering the losses. So that was in short US subprime crisis. They have been highly criticized for undertaking the risk involved with the new complex securities that fueled the United States housing bubble, such as mortgage-backed security and collateralized debt obligations. So the rating agencies did not do their work properly also. If they would have done their homework properly, their work properly, then probably, but not guaranteed, the crisis would not have been so deeper. Okay. So now you read some statistics. An estimated $3.2 trillion in loans were made to homeowners. Now what is $3.2 trillion? This is $3.2 trillion. In Indian rupee, you have to multiply by something like 70 or 72. Okay. So that is the amount of loan they had given to homeowners with bad credit and undocumented income also. That means their banks also did not do the credit checking properly, credit worthiness checking properly. For example, subprime or Alt A mortgages. What do you mean by Alt A mortgage? Right, Alt A mortgage up to here. What is an Alt A mortgage? An Alt A mortgage is a type of US mortgage An Alt A mortgage is a type of US mortgage that for various reasons is considered riskier than A paper. That means they are very risky. They are risky than A paper. A paper means they are less risky or they are good quality. Alt A means bad loans, riskier loan. And this went on for how many years? 5 years. 2002 to 2007 continuously they were disbursing housing loan. And as I told you earlier, that initially the interest rate was lower also for a few years in order to attract the customer, you can say, client. But later on the interest rate was high and therefore they were not able to pay. And they dependent on houses. And we have the house as a security. But if everybody starts selling the house and there is no buyer, the prices of houses also crashed. So these mortgages could be bundled into MBS and CDO securities that received underline high rating and therefore could be sold to global investors. So what they did, these banks and these investment bankers, they created MBS and CDO securities, means backed by collateral. CDO means different types of layers they have created. Those who want high risk, they will be given high interest. Those who want less risk will be given lower interest, but then in case of default, Accordingly, their losses will be decided. That is CDO securities. And because they were given high rating, they attracted lot of global investors also. Why it was a global crisis? See the amount, 3.2 trillion. Even people from different countries, they invested in these bonds or whatever the securities were there, complicated securities. Higher ratings were believed justified by various credit enhancement including over collateralization, that is placing collateral in excess of the debt issued, credit default insurance. What is credit default insurance? You will see in chapter number 15. Okay, but it is an insurance product. An insurance company which guarantees that in case if the borrower does not pay, we will pay. That is credit default insurance. What was the reason for high rating? There was over collateralization. Over collateralization means you have given more collateral than the loan taken. So credit rating company thought there is no risk. Plus it was insured by the insurance company. And there were equity investors who were willing to bear the losses. The critics claim that the rating agencies were the party that performed the alchemy that converted the security from F rated. F means it is the worst form of security. A, B, C, D, it is more than D. You knew that nothing is going to come back. And how much rating they have given? A. Wow. That is what in India now these movie makers also do. Film producers. Even if a third grade movie, they will ask the rating newspapers or the critics, you please give 4 rating, 5 rating. At least will recover some money in the first few weeks only. Okay. So even newspaper rating of Hindi movies, you can't trust them now. The bank could not have done what they did without the complicity of the rating agents. So normally when we see the rating A rated, we feel little confidence and we did not take enough efforts to check whether this was really right. Okay, borrow more. Insurance company, more premium they are earning because they thought the risk is very less. Whatever premium I am earning is my income. And see the insurance company story. Yesterday it was getting late, so I have not told you. Now there are 100 banks in USA. These are banks. This is insurance company. They are insuring the product of every bank. From every bank they are earning 1 or 2%. Okay. So, and all this was, they thought it was a free income. I don't have to do anything. Nothing is going to go wrong. It is A rated instrument. And I will also get 1 or 2% interest from each and every customer which they have lent. Without the AAA rating, the demand for the securities would have been considerably less. But the demand was created because of wrong rating. My topic is how credit rating companies were involved in subprime crisis in USA. By looking at the AAA rating, nobody bothered to check the riskiness involved. And these were big rating agencies. Already you have seen their names. Fitch, Moody, S&P. Bank write-downs and losses on these investments totaled only 523 billion. 1 by 6. That's a big amount. This is more than GDP of, I think, India. No, I don't know exactly, but at least more than GDP of Nepal, Pakistan, Bhutan put together. Okay. That much amount of bad debt they had to write off. Imagine if this would have happened in India, so many banks would have collapsed only. Because they don't have so much capital only to absorb a loss of $500 billion. The rating of these securities were a liquidity business for rating agencies. Even the rating company was making big money. So if you have to rate bonds of 3.6 or something that $1 trillion, how much money they would have made, accounting for just under half of the Moody's total rating revenue in 2007. So 50% of revenue of this company, Moody, one of the three big rating agencies, 50% revenue came from rating of these instruments. So what will other rating agencies do? They will also do the same. Otherwise, they will lose business. So through 2007, rating companies enjoyed record revenue, record profits, and record share prices. The rating companies earned as much as 3 times more for grading these complex products than corporate bonds, that is their traditional business. What is the traditional business of a rating company? Usually they rate a simple bond and debenture. A simple bond and debenture is an instrument where the company pays interest periodically and repay the principal on maturity. But this MBS, mortgage backed security, collateralized debt obligation, these are complex securities. They are backed by some security, they are dependent on somebody is repaying their loan, and out of that the security will be paid. So they took 3 times fees. They said, oh, the work is complicated, so we'll charge more fees. Okay. And their income was very high during this period. Rating agency also competed with each other. I have told you, if one party is making profit, other can't sit behind. Okay. To rate particular MBS and CDO security issued by investment banks, which critics argued contributed to lower rating standards. Such a sad state of affair. The rating companies, in order to make money, they have reduced their own grading, own rating, own standard. And in case if they don't give good rating, the company will say, okay, Tata, bye. We will hire another agency. Like in audit firm also it happens. You don't know. Behind the scene, management says no, what do you call it? Audit qualification. No qualification. If auditor says no, we think we need to qualify the audit report, then they say okay, next year bye bye. Okay. And they get remuneration of say 25 lakh rupees, 50 lakh rupees. For listed company, crores of rupees. What will they do? Will they take the risk of losing that client? No. Some of them, they take the risk, like many big four firms, they don't compromise many times. But many times they compromise also. Otherwise, why would Satyam have happened? Why would Punjab National Bank have happened? Why would ILFS would have happened? Auditor must have known this, or at least they had some idea about it. They should have gone deeper into that. So same thing in credit rating companies, big business. We don't want to lose that income. Now the last few paragraphs, limitations of credit rating. Although credit rating have many positive aspects, there are few limitations. Let us quickly look at them. First is ratings do not remain constant forever. Ratings given to instrument can change over a period of time. Possible? Yes, because situations would have changed. Many new things would have happened which would have changed the ability of the company to repay the loan. Government policy would have changed in this last 2-3 years. New competitor could have emerged. Market interest rate would have changed. Political risk may have increased. So they have to be kept under rating watch. Downgrading of an instrument may not be timely enough to keep investor educated over such matters. This is one serious drawback of rating. Suppose after 2 years they downgrade an instrument. But what about those investors who have already invested? What about those investors who have already invested? Even if they want to now come out, the value of such bonds would have fallen and they might suffer the losses. Second is industry specific rather than company specific. Downgrades are linked to industry rather than company performance. So it is possible that a credit rating company may have downgraded a particular instrument because that industry may not be performing well, instead of looking at the company's performance. Agencies give importance to, agencies means credit rating agency, gives importance to macro aspect and not to micro ones, and overreact to existing conditions which come from optimistic or pessimistic views arising out of up or downturns. This is a very general statement. Every agency may not exactly follow this. They are saying that industry looks at, agencies look at macro aspect. If suppose they get the news that automobile industry will not do well this year for whatever reasons, then they may downgrade a debenture issued by, say, X Limited, which is an automobile company. But X Limited may be a good company. So sometimes they overreact. Sometimes rating agencies overreact, and that may be a harmful thing for a company which has actually done good. Next is cost benefit analysis. The rating agencies charge a huge amount of fees nowadays, and rating being mandatory, it becomes a must for entities rather than carrying out cost and benefit analysis. If you add the rating agency fees also, their effective borrowing cost will go up. What our institute is saying, it is the institute's view. Rating should be left optional, and the corporate should be free to decide that in the event of self-rating, nothing has been left out. But no, SEBI will not agree to this institute view. If companies are allowed to do self-rating, this is India, okay? This is like self-assessment. What people do in self-assessment, first they decide how much tax has to be paid. Say he wants to pay 250 rupees only. Accordingly, he prepares P&L account. So SEBI knows this. So right now mandatory for many instruments in India. Optional is not there. This is institute views. Then conflict of interest. Rating agency collect fees from the entity. This is a serious challenge. We don't know how to overcome this. Same problem arises in audit also. The rating agency collect fees from the entity it rates, leading to a conflict of interest. You are going to charge this company, suppose this is rating company CRISIL, this is X Limited. X Limited pays fees to this company, and you have to give an opinion on X Limited. What will you do? You will try to give good rating, because next time if you give a bad rating, X Limited will hire another agency. Okay. So that is a problem in many fields like auditing, credit rating, where the client gives you money to tell the client you are good or bad. If you say you are bad, he says, why I am paying you? Rating market being competitive, another problem. When there is a competition, then in order to get the client, they may not follow the ethical standards. They may not follow the desired standards. There is a distant possibility of such conflict entering into the rating system. Corporate governance issue, next problem. Special attention is paid to rating agencies getting more of its revenue from a single service or group. In case if you're getting a lot of revenue from a particular group of company, chances are that your integrity may be compromised. Possible. If you have suppose this group of companies holding subsidiary, one more subsidiary, associate, joint venture, and you are asked to do the rating of this entire group, so you can earn a lot of money from this group. So will your integrity not be compromised? The chances are that it can be, because you can't afford to lose such a big group as your client. So rating agency is getting more of its revenue from a single service or group. Rating agencies enjoying a dominant market position, engaging in aggressive competitive practices by refusing to rate a collateralized securitized instrument, or compelling an issuer to pay for the services rendered. Some of the rating agencies, if they are very big, they may use aggressive competitive practices. Okay, they may demand a high fees for rating a particular instrument. They may refuse to rate an instrument. They should have written compelling an issuer to pay high fees for services rendered. And greater transparency in the rating process, in the disclosure of assumptions leading to a specific public rating. So first you make a small correction here. Compelling an issuer to pay high fees for services rendered. Written, those earlier only CRISIL was there some years back, and if suppose you want to issue an instrument, you have to go to CRISIL only. Then what CRISIL will do? Will not rate you, and if they don't rate you, you can't issue the instrument. So they will demand high fees. Okay. Next is what the institute has written. There must be greater transparency in the rating process. That means the rating agencies must make a disclosure of assumptions they have made in providing a rating. Right now, if you look at the rating in a newspaper, they will say this is a AAA rated instrument. That's it. What they should also do, they should also give the assumptions. How did they come to this conclusion about AAA rating? This will create more confidence in the public. Is it right? So institute material is over here. I have added one more paragraph from my side also. Last paragraph from my side. Precautions to be taken while using credit rating. What do you mean by precaution? That is, you are an investor. You are investing in a corporate bond or debenture or any instrument, and you see the credit rating. So what are the precautions you will take when you use the credit rating in investment decisions? One, credit ratings are not recommendation. Credit rating company is not asking you to buy, sell or hold a specified rated security. Okay, they are only an opinion. They are not asking you to buy or sell or hold. It is up to you. I will say Pune is a good city. I am not asking you to come and stay here. That is your choice. But I gave you my opinion. This is what credit rating does. Many people misinterpret as they are recommending the security to be bought. No, they are not. It is your call. Okay. Nor they are offered as guarantees or protection against default. Suppose there is a company whose instrument was rated AAA by CRISIL. Okay. Let us say there is a company IL and FS, Infrastructure Leasing and Finance Company. It had issued some instrument which was rated by CRISIL as AAA. But this company has defaulted, for example. And then there is an investor. He goes and files a case against CRISIL. He says, see, you had given the credit rating. Based on that, I invested. So I want to recover money from you now. Possible? You can keep on fighting in the court of law. CRISIL will say at that point of time, this is what my opinion was. Later on, if things go wrong, I do not take guarantee of that. Credit rating is only an opinion. It is like you saw 4-star or 5-star rating for a movie and you went to watch that movie. Later on, you found that it was such a hopeless movie. Are you going to sue that critic who has given that rating? No. You can't. It is your choice. He did not force you to watch the movie. Second precaution, specific credit rating opinions are not intended to measure many of the other factors that fixed income investor must consider in relation to risk, such as liquidity risk, prepayment risk, interest rate risk, risk of secondary market loss or exchange loss, etc. So if a credit rating is given for a fixed security like debenture or bond, they are only giving opinion on the ability of the company to pay interest and principal on timely basis. They may not cover every type of risk associated with a bond or debenture. For example, liquidity risk. For example, prepayment risk. They don't give this assurance that company may not prepay you, or market rate of interest may go up, the value of the bond may change. I am not giving you that assurance. Or the risk of secondary market loss, that is in the market the price may fall, or the exchange loss risk, etc. These are the precautions you have to take. Rating is specific to the instrument. On the first lecture I have told you, and it may not be the rating of the company. They are rating instrument, not the company. Point 4, rating may differ with respect to different instrument of the same organization. A commercial paper may be rated differently, a 5-year bond may be rated differently, and a fixed deposit may be rated differently. By looking at the rating given to commercial paper, say AAA or the highest safety bond, you can't take a judgment for a long-term bond. Okay? Because the risk of a short-term instrument can be different from the risk of a long-term instrument. Short-term risk is less because we know in next 6 to 8 months this is what can happen. But 5-year bond, we don't know 5-year what will happen. So therefore, each instrument has different rating and it is possible. Organization is one, 3 instrument with different rating. Also, different rating assigned to 2 different instruments of 2 different organizations does not indicate the superiority or inferiority of the organization. Reliance bond got AAA, Tata Steel got AA. Can we conclude Reliance is a better company than Tata Steel? No, that rating was given to their respective debenture or bonds. It was not given to the company. So do not misinterpret that if the rating is poor, it's a bad company compared to other, or if the rating is high for an instrument, it is a better company than the others. But normally this is how the companies market themselves. Do you know that? Even though the rating is for an instrument, but they say we are a AAA rated company. Actually, it is a wrong statement. Our bond was given AAA rating by CRISIL. In the opinion of CRISIL, this bond is AAA rated. That is how the statement should be put. Okay. Now this wonderful chapter is over.